The headlines are all saying the same thing, that the entire U.S. housing market, your ability to buy a home, the value of your biggest asset, hangs on the words of one man in Washington, D.C. They tell us the Federal Reserve holds the keys, that if they cut interest rates, the market will roar back to life. And if they don't, it will all come crashing down. But what if that's a lie? Not a malicious lie, but a dangerously outdated one. What if the lock has been changed and the Fed's key doesn't fit anymore? The truth is, the American housing market is fracturing. It's breaking into two separate parallel economies, one for the ultra-wealthy and one for everyone else. And this hidden fracture is creating a new, more dangerous kind of bubble, one the Fed is powerless to stop. So if you want to understand the real reason the housing market is on a knife's edge, and it's not what you think, then you need to understand the great uncoupling. Stick with me, because by the end of this video, you'll see this market in a completely new way. To understand why the old rules don't apply, we have to start with the most basic part of any market: supply. For decades, the housing market had a natural rhythm. Older generations would sell their homes to downsize, and that supply of existing homes would become available for younger generations to buy. But that rhythm is broken. We are now living through the Great Lock-in, and it's being caused by the baby boomer generation. By 2030, every single baby boomer will be over the age of 65. But unlike previous generations, they aren't moving. They are aging in place. Whether it's for emotional reasons or because there simply aren't enough suitable, smaller homes to move into, the result is the same. Millions of single-family homes are being held off the market, perhaps permanently. This isn't a temporary shortage. It's a structural crisis, but it gets worse. The homes we do have are fundamentally mismatched with the families we have today. The classic 3-bedroom suburban house was built for the 20th century nuclear family. But today, nearly 30% of American households are people living alone. They need smaller, more affordable condos and apartments. At the same time, for economic and cultural reasons, multi-generational living is on the rise, creating demand for larger, more flexible homes. The market is failing to provide either. So we have a massive demographic wave holding onto the existing supply and a new housing stock that doesn't fit the needs of modern buyers. What happens when you have fixed, inflexible supply? Any increase in demand from any source doesn't create more houses. It just creates higher prices. The market has lost its ability to regulate itself. It has become structurally inelastic, and that makes it the perfect breeding ground for a bubble. Now let's look at the other side of the equation: the traditional buyer, the person who needs a mortgage. While the supply of homes is locked up, the ability of the average American to even qualify for a loan is being crushed by something most housing analysis completely ignores: consumer debt. Before you can even think about a mortgage, you have a debt-to-income ratio, or DTI. It's a simple number lenders use. They add up all your monthly debt payments and divide it by your gross monthly income. If that number is too high, usually above 43% including your potential mortgage, you're out. No loan. For millions of potential home buyers, their DTI is already dangerously high before they even start house hunting. That $700 car payment, those student loans, that rising credit card balance, it all acts like a giant anchor weighing down their borrowing power. This makes the traditional buyer pool incredibly fragile. A small increase in mortgage rates doesn't just make the monthly payment a little higher. For a household already burdened with consumer debt, it can be the final push that raises their DTI above the limit, disqualifying them from homeownership entirely. This is a critical piece of the puzzle. The foundation of the traditional debt-driven housing market is weaker than it has been in generations. Millions of Americans are being systematically excluded. So, if they aren't the ones buying these increasingly expensive homes, who is? If you're starting to see that the housing market is more complex than just what the Fed is doing, do me a favor and hit the like button. It tells YouTube that this kind of deep dive analysis is valuable, and it helps the channel reach more people who need to hear this. This brings us to the core of this crisis, the single most important economic chart you need to see to understand the modern housing market. This is what I call the Great Uncoupling. For most of modern history, these two lines move together. For prices to go up, people had to borrow more money. Simple. But after the 2008 financial crisis, something changed. Prices became uncoupled. from the mortgage debt of ordinary people. Prices are soaring, while relative mortgage borrowing is stagnating. This is mathematical proof that the market is no longer being primarily driven by families taking out loans. It's being driven by wealth. After 2008, two things happened. First, lending standards got much tighter, locking out the debt-burdened buyers we just talked about. Second, a decade of 0% interest rates and a roaring stock market created a massive pool of cash in the hands of corporations, investment funds, and high-net-worth individuals. That cash needed a place to go to find a return, and it found U.S. real estate. This has effectively split the housing market in two. In Market A, the debt-dependent market, you have first-time buyers and regular families. They are fighting over a shrinking supply of homes, weighed down by consumer debt, and are completely at the mercy of the Federal Reserve's interest rate decisions. But in Market B, the wealth-driven market, you have investors and all-cash buyers. They aren't looking for a mortgage application, they're looking at asset returns. They are largely insulated from interest rates. In fact, a rate hike that spooks the stock market might just push more of their capital into the perceived safety of hard assets like real estate. This explains the insanity of the last few years. The Fed jacks up interest rates to the highest level in decades. Market A gets crushed, bidding wars disappear, sales to regular families plummet. And yet, prices don't crash. Why? Because Market B sees it as a buying opportunity. They step in with cash, buy the dip, and often turn those homes into rental properties, further shrinking the supply of homes for sale to Market A. This is the fracture. A market of debt-based have-nots competing against a market of equity-based haves. And the Fed's primary tool, interest rates, is a surgical weapon against Market A, but a complete blunt instrument against Market B. The Fed is fighting a war with an army that can only see half the battlefield. So, is this a bubble? Yes, but it's a new and more dangerous kind. To understand it, you need to know the difference between a rational problem and irrational behavior. A housing bubble is when prices detach from economic fundamentals, like rental income or construction costs. It's driven by what economist Robert Shiller calls irrational exuberance, a collective belief that prices will go up forever simply because they have been going up recently. It's pure speculation. Purely irrational bubbles are fragile. They're built on nothing but hype. But the current bubble is different. It's built on a foundation of truth. The supply crisis we talked about in Chapter 1? That's a real rational problem. The demographic lock-in is real. The housing mismatch is real. These are fundamental economic reasons for prices to be high. And this is what makes the current situation so dangerous. This rational story of a permanent shortage provides the perfect fuel for the fire of irrational speculation. Investors can tell themselves, this time is different. It's not a bubble because there's a real shortage of homes. This belief allows the speculative feedback loop to take hold with incredible force. It allows prices to not just reflect the shortage, but to wildly overshoot it. Think of it like this. The rational shortage might justify a 20% increase in prices. But the irrational exuberance fueled by that story pushes prices up by 60%. That gap, that 40% difference, is the bubble. It's a hybrid bubble, a parasite of irrational speculation that has attached itself to a host of rational supply problems. And that makes it far more resilient to things like interest rate hikes. But it also makes the eventual fall that much more devastating. Because when the speculative belief finally breaks, prices won't just fall back to a reasonable level. They will crash through it, as years of manic overpayment correct all at once. This is a complex topic, and I want to know if it's making sense. Let me know in the comments. Have you personally seen the effects of this fractured market in your own neighborhood? Your stories help us all understand the real-world impact. And if you're getting value from this, subscribing ensures you won't miss our future analyses. So, where does this leave us? We have a housing market that is fundamentally broken. It's been uncoupled from the wages of working people. It's been fractured into a two-tiered system of debt and wealth. And it's trapped in a hybrid bubble where a real supply crisis is fueling an irrational speculative boom. The focus on the Federal Reserve is a distraction. They are trying to perform surgery with a sledgehammer, blind to the true nature of the market's illness. The purpose of this video was not to give you a simplistic price prediction. It was to give you a new lens, a new framework for understanding. When you read a headline about interest rates, you'll now know to ask, but how does this affect the wealth-driven buyers? When you hear about a housing shortage, you'll know that it's a structural demographic issue, not just a temporary lack of construction. And when you see prices continue to defy gravity, you'll understand the dangerous interplay between a rational problem and the irrational exuberance it enables. Knowledge is the only real defense in a market this complex. You are now equipped with a deeper understanding than 99% of the people talking about this topic. Use it to make smarter decisions, to see past the noise, and to prepare for a future that will not follow the old rules. If this analysis has opened your eyes and you want more content that respects your intelligence and goes beyond the shallow headlines, make sure you subscribe to the channel and turn on notifications. Our goal here is to build a community of the sharpest thinkers in finance. Thank you for watching.